Bank battle. Deutsche Bank just lost 3 million ounces. To J.P. Morgan, 3 million ounces moved in silence while the world celebrated New Year. Deutsche Bank emptied its vault. J.P. Morgan took every ounce. But this wasn't a sale. This was a surrender. The registered inventory at COMEX down to 36 million ounces. At this rate of depletion, the math says 8 weeks. 8 weeks until the vault is empty. China sealed its borders to silver exports this week. The retail market sold out until March. The price on your screen says one thing, but the vaults tell a different story. What happens when the last ounce is gone? Welcome to Currency Archives. If you've spent decades watching markets, you know that some transactions carry weight beyond their numbers. This is one of those moments. We'd appreciate it if you'd subscribe to this channel, the way you'd bookmark a critical research document you'll need to reference again. And please, let us know in the comments, which corner of the world are you watching this from today? Now, let's examine exactly what happened. On January 2nd, 2025, something extraordinary occurred inside the vaults of the COMEX exchange in New York. The CME Group delivery report recorded a transaction that most traders would never notice, but those who understand the mechanics of physical settlement knew immediately. This was not normal business. Deutsche Bank issued delivery notices for 600 contracts. Each contract represents 5,000 ounces of physical silver. The mathematics are simple. 600 contracts multiplied by 5,000 ounces equals 3 million ounces of silver. But the critical detail was not the volume. It was the recipient. J.P. Morgan stood on the other side of every single contract. They demanded delivery. They took physical possession. They moved 3 million ounces from Deutsche Bank's vault allocation directly into their own registered inventory. This was not a negotiation. This was not a gradual transfer spread over weeks or months. This was a single session event, executed with precision, completed before most market participants had returned from their holiday break. The analysts who monitor vault activity noticed something else. This transfer reduced the total registered silver inventory at COMEX by nearly 8% in one transaction. Registered inventory represents the physical metal available for immediate delivery against futures contracts. Before this event, the COMEX held approximately 39 million ounces in registered vaults. After Deutsche Bank's delivery, that number dropped to 36 million ounces. The significance becomes clear when one examines the delivery patterns over the previous 48 hours. On January 1st, the exchange recorded another massive delivery event, 278 contracts changing hands. Combined with the January 2nd transfer, the total physical settlement reached 2,178 contracts in 2 days. That represents 14.4 million ounces of silver, demanded, delivered, and removed from the available pool in 48 hours. Global silver production stands at approximately 800 million ounces annually. In the first 2 business days of 2025, the COMEX facilitated the transfer of nearly 2% of the entire year's global mine supply. This was not commercial hedging. Manufacturers who use silver in industrial applications do not order millions of ounces on a Friday afternoon. Their procurement departments work months in advance, negotiating contracts, arranging logistics, managing inventory slowly and predictably. This was institutional positioning. The delivery reports show a pattern that experienced market observers recognize immediately. This was a calculated raid on available inventory by entities who understood exactly what they were doing. Deutsche Bank's role in this transaction raises important questions. For years, Deutsche Bank maintained significant vault holdings in precious metals. They operated as a major clearing member, facilitating deliveries for clients, maintaining inventory to support their metals trading desk. But their vault activity over the past 18 months tells a story of systematic reduction. Month after month, their registered holdings declined, not through sales to the open market, but through direct transfers to other institutions. J.P. Morgan's position represents the opposite trajectory. Since 2020, J.P. Morgan has accumulated physical silver with mechanical consistency. Their vault holdings have grown from modest levels to a dominant position that now represents the largest concentration of registered silver at the exchange. They did not buy this metal on the open market where purchases would move prices. They accumulated through the delivery process, standing for physical settlement, taking possession of actual bars, storing them in their own vault allocations. The January 2nd transaction was not an anomaly. It was an acceleration of an existing pattern. The question that strategists are now asking is simple but profound. Why did Deutsche Bank liquidate 3 million ounces to a single counterparty in a single session? Was this a voluntary transaction, or was Deutsche Bank forced to meet an obligation they could not refuse? The mechanics of future settlement create binding legal obligations. When an entity is short a contract and the long holder demands delivery, the short must deliver the metal or face default. Default at the COMEX is not a theoretical concept. It triggers regulatory action, financial penalties, and potentially the suspension of clearing privileges. Deutsche Bank delivered the metal, JP Morgan took possession, and the registered inventory available to satisfy future delivery demands dropped by 3 million ounces in a single afternoon. The implications of this transaction extend far beyond two banks exchanging metal. This was a stress test of the physical settlement system, and the system bent under the pressure. The vault holdings of a major bank tell a story that quarterly earnings reports never reveal. Deutsche Bank's relationship with precious metals markets stretches back decades, through different eras of global finance, through boom cycles and crashes, through regulatory transformations that reshaped how banks interact with commodity markets. But something changed in 2023. The data from COMEX vault reports began showing a pattern that commodity analysts found unusual. Deutsche Bank's registered silver inventory, which had remained relatively stable for years, began declining steadily, not through normal market sales, not through client withdrawals spread across multiple counterparties. The metal was moving in large blocks to specific institutions through the delivery mechanism. By the end of 2024, Deutsche Bank's vault position had been reduced by approximately 60% from its peak levels 2 years earlier. Then came January 2nd, 2025, and the remaining concentrated position moved to JP Morgan in a single transaction. This raises a question that few market commentators are asking publicly. Was Deutsche Bank exiting the physical silver market by choice or by necessity? The bank's history in metals trading includes a chapter that most institutions would prefer to forget. In 2016, Deutsche Bank reached a settlement with U.S. regulators regarding precious metals price manipulation. The settlement involved cooperation with ongoing investigations, disclosure of trading practices, and operational restructuring of their metals desk. Since that settlement, Deutsche Bank's approach to commodities has shifted noticeably. They reduced proprietary trading activities, they scaled back client services in certain metals, they restructured their clearing operations. The steady decline in vault holdings appears consistent with a broader strategic retreat from physical commodity exposure. But timing matters in markets. The acceleration of this exit, particularly the final 3 million ounce transfer, occurred at a moment when physical silver inventory globally was becoming increasingly constrained. JP Morgan's position represents the mirror image of Deutsche Bank's retreat. Where Deutsche Bank withdrew, JP Morgan advanced. The data is remarkable in its consistency. Month after month, year after year, JP Morgan's registered vault holdings grew, not erratically, not in response to short-term price movements, but with mechanical precision that suggests a multi-year strategic plan. By January 2025, JP Morgan controlled approximately 55% of all registered silver at the COMEX. This concentration is unprecedented in modern commodity markets. To understand the significance, one must understand what registered inventory represents. These are not bars held for clients. These are not eligible stocks that might become available under certain conditions. Registered inventory means metal that is specifically allocated, warranted, and available for immediate delivery against futures contracts. JP Morgan now controls the majority of that deliverable supply. This creates asymmetric power in the physical settlement process. When contracts approach delivery month, and traders must decide whether to roll their positions forward or stand for delivery, the available inventory determines the leverage dynamics. If inventory is abundant, shorts have options. They can deliver from multiple vault sources, they can negotiate, they can manage their exposure with flexibility. But when inventory is concentrated in the hands of a single institution, the dynamics shift fundamentally. JP Morgan does not need to manipulate prices through trading. They control the physical settlement mechanism through inventory ownership. The January transaction with Deutsche Bank strengthened this position further. Industry analysts have noted that JP Morgan's accumulation strategy parallels their approach in other commodities. They do not chase prices. They do not speculate on short-term movements. They accumulate physical assets during periods when others are reducing exposure. This strategy requires patient capital, institutional backing, and a long-term view that extends beyond quarterly performance metrics. Deutsche Bank's exit and JP Morgan's accumulation represent more than two banks adjusting their commodity portfolios. This represents a fundamental transfer of market power. The ability to deliver physical metal, or to withhold it, creates leverage that financial instruments cannot replicate. In markets where physical settlement is rare, where most contracts are cash settled or rolled forward, this might not matter significantly, but silver markets are different. Industrial users need physical metal, electronics manufacturers, solar panel producers, medical equipment companies. They cannot accept cash settlement when they need actual silver for production. And when those industrial users turn to the futures market to hedge their supply needs, they discover that the entity controlling the majority of deliverable inventory is JP Morgan. The strategic implications extend beyond individual transactions. This concentration of physical inventory, combined with a reduction in global supply availability due to export restrictions, creates a market structure that favors those who position themselves early. Deutsche Bank recognized the changing landscape. They chose exit over competition. JP Morgan recognized the same landscape. They chose accumulation over caution. The 3 million ounce transfer on January 2nd was not the beginning of this story. It was the consolidation of a multi-year strategic shift, executed in plain sight, documented in public vault reports, yet largely ignored by mainstream financial analysis. The question now is not what happened. The question is what happens next, when the remaining inventory comes under pressure from demand that cannot be satisfied elsewhere. December 31st, 2024 marked the end of an era that few people outside commodity circles noticed. On that date, China's new export control regulations became legally enforceable. The announcement had been made months earlier. The administrative framework had been published. But January 1st, 2025 was the day the restrictions went live. Silver was on the list, not completely banned, not entirely prohibited, but restricted to 44 specifically licensed export firms, subject to documentation requirements, approval processes, and government oversight that transformed a once fluid market into a controlled pipeline. The timing of the Deutsche Bank transaction, executed on January 2nd, the first business day after these restrictions took effect, was not coincidental. For decades, China served a unique role in global silver markets that most investors never understood. China is the world's largest silver producer, mining approximately 3,600 metric tons annually. But China is also the world's largest silver consumer, using the metal in solar panels, electronics, batteries, and industrial applications at rates that exceed domestic production. This created a paradox. China imports silver when domestic supply cannot meet industrial demand. But China also exports refined silver when arbitrage opportunities emerge between Shanghai prices and Western markets. This two-way flow acted as a pressure release valve for global markets. When COMEX inventories tightened, Chinese metal could flow westward if the price differential justified the logistics. When Shanghai premiums rose, Western metal could move eastward through Hong Kong and established trading channels. The new regulations severed this mechanism. Only 44 firms now hold licenses to export silver from China. These firms operate under government supervision. Their export volumes require approval. Their customers must be documented. The entire process introduces friction that discourages opportunistic arbitrage. More critically, these firms operate under strategic guidance from Beijing. China's export restrictions are not primarily about silver. They are part of a broader resource nationalism strategy that encompasses rare earth elements, gallium, germanium, and other materials critical to advanced manufacturing. The Chinese government learned from its experience with rare earth exports. In 2010, China restricted rare earth shipments during a diplomatic dispute with Japan. Global prices spiked. Western manufacturers faced supply disruptions. Alternative sources took years to develop. The lesson was clear. Control of physical resources creates geopolitical leverage that financial markets cannot easily bypass. Silver fits this strategic framework perfectly. The metal is essential for solar panel production, an industry where China holds dominant global market share. It is critical for 5G infrastructure, electric vehicle components, and military electronics. By restricting exports, China ensures domestic supply for its own industrial priorities while creating supply uncertainty for Western competitors. The sophisticated institutions trading at COMEX understood these implications immediately. The historical arbitrage between Shanghai and New York typically ranged between 50 cents and $2 per ounce, depending on logistics costs and currency fluctuations. When Shanghai prices rose significantly above COMEX, metal would flow from west to east. When COMEX prices offered better returns, Chinese refined silver would move westward. This arbitrage kept global markets connected. It prevented extreme price dislocations. It ensured that physical metal could reach the market willing to pay the highest price. The export restrictions closed this window. Western banks and industrial buyers now face a stark reality. The swing supply from China is no longer accessible through normal commercial channels. The 44 licensed firms are not responding to market signals. They are responding to government directives. If Beijing decides that domestic solar panel manufacturers need silver more than Western buyers, the export licenses simply are not approved. This explains the urgency behind the massive delivery demands at COMEX in early January. The institutions standing for delivery were not speculating on short-term price movements. They were securing physical inventory before the full implications of the Chinese restrictions became apparent to the broader market. JP Morgan's 3 million ounce acquisition from Deutsche Bank must be viewed through this lens. They were not buying silver. They were buying insurance against a supply chain that had fundamentally changed overnight. The historical data reveals the magnitude of this shift. Over the past 5 years, China exported an average of 800 to 1,200 metric tons of refined silver annually to Western markets. This represented approximately 10 to 12% of the COMEX's annual delivery volume. That supply is now effectively unavailable. Western industrial users who previously relied on Chinese refined silver as a backup source when COMEX inventories tightened no longer have that option. The geopolitical calculation extends beyond simple supply and demand. China's restrictions create dependency that can be leveraged in negotiations unrelated to silver markets. Trade discussions, technology transfer agreements, diplomatic positioning, the control of physical resources provides bargaining chips that appreciate in value as alternatives become scarcer. The Western response has been fragmented. Some governments are investing in domestic mining expansion. Some are exploring recycling technologies to recover silver from electronic waste. Some are researching alternative materials that could reduce silver consumption in industrial applications. But these solutions require years to implement. Mining projects need permitting, financing, construction, and ramp-up time. Recycling infrastructure must be built. Alternative materials must be tested, certified, and integrated into manufacturing processes. In the immediate term, the only available supply is what already exists in accessible vaults, and those vaults are being drained at unprecedented rates. The Chinese export ban was not the cause of the inventory crisis at COMEX, but it was the catalyst that accelerated behaviors that were already emerging. It transformed a gradual inventory decline into an urgent scramble for physical metal. It changed the calculation for every institution holding short positions in futures markets. And it made the 3 million ounces that moved from Deutsche Bank to JP Morgan worth far more than the spot price on any electronic trading screen. The metal was not just silver anymore. It was strategic inventory in a market where replacement supply had suddenly, and perhaps permanently, disappeared. The COMEX vault system operates on a principle that most market participants take for granted: the assumption that physical metal will always be available to satisfy delivery obligations. For decades, this assumption held true. Inventory levels fluctuated, prices moved up and down, but the registered vaults always contained sufficient metal to prevent systemic failures in the delivery process. January 2025 challenged this assumption in ways that commodity markets have not experienced in modern history. The numbers tell a story that cannot be dismissed as temporary volatility. Before the New Year delivery surge, COMEX registered silver inventory stood at approximately 39 million ounces. This represented the physical metal available for immediate delivery against futures contracts. After the first 2 trading days of January, after the massive delivery demands that included Deutsche Bank's 3 million ounce transfer to JP Morgan, registered inventory dropped to 36 million ounces. A decline of 3 million ounces in 48 hours represents an 8% reduction in total deliverable supply. But the trajectory is more concerning than the absolute numbers. Analysts who track vault activity began performing calculations that revealed an uncomfortable mathematical reality. If delivery demands continued at the rate established in early January, the registered inventory would reach critically low levels within 8 to 10 weeks. Critically low does not mean zero. It means insufficient to cover the open interest in active delivery months without triggering position limits, emergency measures, or delivery failures. The exchange has mechanisms to prevent complete inventory depletion. They can raise margin requirements. They can impose position limits on individual traders. They can declare force majeure under extreme circumstances. But each of these mechanisms carries consequences that damage market credibility. Traders participate in futures markets based on the belief that contracts are enforceable, that physical delivery is available if demanded, that the exchange will honor its obligations. When exchanges impose emergency restrictions, that belief erodes. The registered inventory crisis is compounded by what is happening in the eligible inventory category. Eligible inventory represents silver held in COMEX vaults that meets exchange specifications but is not currently warranted for delivery. This metal could potentially be converted to registered status, but only if the owners choose to make it available. As of mid-January 2025, eligible inventory stood at approximately 210 million ounces. This creates a misleading impression of abundance. The reality is that eligible inventory belongs to specific entities who have no obligation to convert it to registered status. Much of this metal is held by JP Morgan in their vault allocations. Some is held by other banks for proprietary positions or client accounts. The owners of eligible inventory are watching the registered category drain, and they are not replenishing it. This behavior reveals a strategic calculation. If registered inventory continues declining, and if industrial buyers or short sellers become desperate for physical metal, the entities controlling eligible inventory gain enormous negotiating leverage. They can choose when to convert metal to registered status. They can demand premiums above spot prices. They can select which counterparties receive access to physical settlement. This transforms the vault system from a neutral infrastructure into a strategic asset controlled by concentrated interests. The retail market is experiencing the consequences of this institutional behavior in real time. Precious metals, dealers across North America and Europe, report inventory situations that they describe as unprecedented. One major dealer in Texas reported in early January that their next available delivery date for silver bars was March 15th. not because of logistics problems, not because of refining delays, but because they cannot source physical metal at current spot prices. Another dealer in London stated that premiums over spot price have expanded from the normal range of 2 to 3% to 12 to 15% for immediate delivery. The disconnect between paper price and physical availability has become undeniable. An investor watching silver prices on a financial website sees a quote around $30 per ounce. But when that same investor attempts to purchase physical bars, they discover that delivery requires waiting weeks or months and paying premiums that push the effective price to $34 or $35. This spread represents a market failure. In efficient markets, when physical premiums rise significantly above futures prices, arbitrageurs step in. They buy futures contracts, stand for delivery, take possession of physical metal, and sell it in the retail market to capture the premium. This arbitrage activity should close the gap between paper and physical prices, but it is not happening at scale. The reason becomes clear when examining who controls the registered inventory. The entities with access to COMEX delivery, the banks and trading firms who can take physical possession, are not selling into the retail market. They are accumulating for their own accounts or for large institutional clients. The retail buyers, the individuals and small businesses who want 100 ounces or 1,000 ounces, have no access to the COMEX delivery system. They must purchase through dealers who are themselves struggling to source inventory. The mathematical projection is straightforward and alarming. If delivery demands continue at 5 to 7 million ounces per week, the registered inventory reaches 20 million ounces by late February. At that level, the exchange faces difficult decisions. They can allow inventory to drain further, risking a delivery failure that would destroy market credibility. They can impose emergency position limits, forcing traders to close positions rather than stand for delivery, effectively admitting that the physical settlement system cannot function as designed. They can halt trading in specific contract months, an action that has historical precedent in other commodity markets, but would send shockwaves through precious metals trading globally. None of these options are desirable. Each represents an acknowledgement that the system is under stress that it was not designed to withstand. The industrial users of silver, the manufacturers who need physical metal for production, are facing supply chain decisions that have no good solutions. They can attempt to secure inventory through the futures market, but this requires posting margin and accepting delivery logistics that many manufacturers are not equipped to handle. They can purchase through traditional suppliers, but face extended delivery times and premium pricing that disrupts their cost structures. They can reduce silver usage in their products, but this requires engineering changes and certification processes that take months or years. The third option, reducing silver consumption, is already beginning. Some electronics manufacturers are exploring alternative materials. Some solar panel producers are researching designs that use less silver per panel. Some are simply accepting higher input costs and passing them to customers. But these adjustments do not happen instantly. In the immediate term, the industrial sector needs physical silver, and the available supply is controlled by entities whose interests do not align with stable pricing or reliable access. The COMEX inventory crisis is not a temporary disruption. It is a structural shift that reveals fundamental weaknesses in how commodity markets operate when physical settlement becomes the primary mechanism rather than a theoretical option that few participants actually exercise. Deutsche Bank's 3 million ounce delivery to JP Morgan was one transaction. But it was a transaction that illuminated a system under pressure, a market where physical metal has become more valuable than the contracts that claim to represent it, and an inventory situation that mathematics suggests cannot continue indefinitely without systemic consequences. The vault numbers decline each week, and the entities controlling what remains are not showing any indication that they intend to make it easily available.